Im folgenden Video hatte ich die große Ehre, ein Gespräch mit Chuck Carneval zu führen, dem Macher von FAST Graphs. Sie kennen wahrscheinlich diese Internetseite, mit der man Aktien analysieren kann und prüfen, ob sie überbewertet sind oder unterbewertet sind. Das Gespräch hat logischerweise auf Englisch stattgefunden. Ich hoffe, dass es trotzdem verständlich sein wird. Wichtig auch an dieser Stelle, der Disclaimer gilt auch für dieses Gespräch. Alles, was Chuck und ich da gesagt haben, dient nur zu Informationszwecken und ist keine Aufforderung, Wertpapiere zu handeln. Sie werden sehen, dass Chuck an manchen Stellen eine Abkürzung nutzt, und zwar den Begriff PE. PE steht auf Englisch für Price-Earnings-Ratio. Das wäre auf Deutsch dann unser KGV, also unser Kurs-Gewinn-Verhältnis. Das ist ein wichtiger Begriff, den Sie kennen sollten, wenn Sie jetzt dieses Video anschauen. Ich wünsche Ihnen viel Spaß dabei. Bis dann. Hello, Chuck. Nice to meet you. I am very glad and honored to welcome you on my channel. Thank you for your time.
Well, it's my real pleasure to be here, Eric. Thanks for asking me.
So, Chuck, you are the founder and the creator of FAST Graphs, which is a fantastic tool to assess the valuation and the quality of a company. I just have a couple of questions before we start. When was FAST Graphs born, and what was the idea behind the concept of creating FAST Graphs?
Well, it's kind of a long story, but I'll try to give you the short. I also am a registered investment advisor and portfolio manager. And I was, when I was in college studying finance, I had an economics professor who I ended up going into partnership in business with, who used to pound the desk when he would talk to us students, and he would say, earnings determine market price. And he had a Pershing study that went back something like 80 years, and it showed the correlation between the S&P 500's earnings and their price over time. And of course, that correlation was very profound. Where earnings go, ultimately stock prices go in the long run. But in the short run, there's also an evil twin sister EDMP, and that is emotions can determine market price. So well, the idea behind the FAST graph was to illustrate this relationship originally between earnings and market price. Now we do it with a lot of metrics, cash flows, EBITDA, EBIT, sales, things like that. But to show that relationship and then utilize it to reveal valuation. And I think that's an important factor, Eric, that I'd like to say about the tool. In my view, it doesn't dictate valuation like a lot of people want it to do. Mm-hmm. It reveals it. In other words, it allows you to analyze the business relative to how the market is valuing that business to help you make a determination whether or not it would be a prudent investment at this time or not, or if it's too expensive, or if it's really inexpensive, and what have you. So it's an analytical tool, I like to say, to think with. But it was formed based on the, teachings of my original mentor in the business, who said earnings determine market price. And it, of course, makes sense. In the long run, how well the business performs is going to determine how well the stock performs if you're a long-term buy and hold investor, especially.
And the platform has gone a long way since then. The platform is also well known in Europe. You have also a lot of German-speaking fans, I would say, and your focus.
Thank you.
Yeah, your focus, nevertheless, is on US stocks, right? You do not analyze European stocks, or is it something you might consider in the future?
Well, I do have a treat for you. I'm not sure I want to go into it right now at this point, but we are testing international stocks. We will have, hopefully within this quarter, maybe even by the end of this month, we will have all international indices and stocks available on FAST Graphs. So that's coming soon. I've got a beta version that I can show you, and you can even we can even look at a couple of stocks if you want to.
Wonderful.
It's not ready for prime time yet. It still hasn't.
Okay, so but it's already a kind of breaking news.
Well, I'm going to say it's 95%, in the works right now. We just have some, little touch-ups we have to do on it, little coding things to, make it work properly. But we will have that very soon.
Okay, wonderful. So Chuck, I discovered fast graphs already a couple of years ago, but then somehow I let it go. I don't know why. But I started to work again with it some weeks ago. And I must say, while it is a fantastic tool, we have to agree that it is sometimes a little bit complex at the beginning. And you agreed and offered to show some features to facilitate the use of this platform. And I would like you now to take over the screen. I give you the word, and you have the possibility to show what you would like to
What was
show
the
to us.
first stock, Eric? What was the first stock? Yes, but was it Apple? Was that the first one you questioned? How
No, it was Tesla, I think.
Tesla. All right, let's look at Tesla then. So I'm gonna bring Tesla up, and you can be giving me the screen. So we have it.
Yeah.
All right, cool. Yeah, Tesla, as you and I have talked now, you originally asked me the question, how come Tesla looks so different when you have different time frames? And it's one of the features that I think really separates fast graphs from other research tools. And Tesla is like a quintessential example of a really strange company. So I want to go over some features. The first thing I want to do is we've got this normal PE, which is this crazy number of 500 times earnings. But you can see, you can't even see that on the back part of the graph here. Are you seeing what I'm showing you?
Yeah.
Doing a double check. So the first thing I do is take the normal PE off because it's aberrant. And now you start to get a reflection of what fast graphs is looking like in terms of revealing valuation. But I want to make a point, Eric. This is the most important part of the graph in helping you understand what you're seeing. Okay, and I want you to notice we have no growth rate in here because we have some negative numbers back here that you really can't compute an effective growth rate mathematically. Okay, so you have to change time frames, and you usually have to start with a positive number. But you can also take the scrolling bar here and go back and see. And just by pointing my thing, there was no PE back here because there was no earnings. You see the negative numbers here. And then here you had 5 cents of earnings in 2013. And you got PEs up here of 600, 300, because I want you to notice earnings are dropping. So you get these aberrant numbers. When I go ahead and bring this back out, okay, I can look like, like right now here, Tesla's starting to look like it's, become reasonably valued. If I move it to here, it starts to look like it's way overvalued and so on. The problem is you're looking at a very dynamic company here. If you look at the bottom of these earnings graphs here, you've got a 13% growth rate in 2011, a minus 45% growth rate, followed by 124%. So this other area below the graph is also critically important because it calculates growth rates. But as I change the time frame, if I'm using a 5-year time frame, which I want to be clear, that's giving me 2 years of history, as you can see by the dark line, almost perfectly now because we're in January.
Yeah.
And then it's giving me 3 years of estimates. Okay, but we got a 203% number, a 79% number, and then we got forecast for 27, 29, and 2. But this 55% is calculated by going from this point to this point. Okay, and at that point, we're drawing this orange line. If you always point to the triangle, and that's something I want all users and subscribers to understand, if you point to the triangle, it tells you what multiple the orange line is drawn in. Now here we're using a 55 multiple. I would argue that that's not a realistic number, okay? Because, although the company did grow essentially at that rate or is expected to grow at that rate over this time frame, it's not a realistic number. Notice if I scroll out the estimate data and just look at these two time frames, I've now got 132% growth. That's clearly unsustainable.
Yes.
And so I'm drawing the orange line now at 132 multiple. So the moral of the story is you want to always make sure you know when you're looking at the orange line what multiple it's being drawn at, and that will tell you in this box here on the graph. And when you're dealing with a company that has such crazy growth as Tesla, for example, I want you to notice that in December of 2020, it actually had a 37,000% increase in earnings. Well, obviously that's not sustainable. That's not realistic and it won't happen. But what we're seeing here is, that Tesla was clearly trading at, by pointing, to these different, dots, different prices on the screen here, we were trading at 185 times earnings, 300 times earnings. It's all based on what the earnings are and how they are. So the key is you're using a tool here. Another good example would be Apple, maybe even a little better because it's not quite as diverse as Tesla is. If you're looking at Apple, and I'm using a long-term time frame here, and I put the normal PE, all this this is a market value PE. This is how the market's valuing the stock. Mm-hmm. This is the theoretical fair value based on intrinsic value formulas. This one is using Peter Lynch's P equals growth rate. But we're looking at Apple here where it grew at 36%. But again, that's contaminated, if you will, by 260% growth, 300% growth. You always want to see what the numbers, because this is a mathematically based tool. If I shorten that time frame to 15 years, now the growth rate has fallen to 18%. Mm-hmm. And now I'm drawing the orange line with a PE equal to the growth rate of 18 times earnings. Yes. And so now I'm looking here, and I'm looking at a time frame when the market was valuing it at 17 times earnings. Now I want to be clear about this. I consider both of these numbers the same. Okay, they're different, obviously, because the mathematics comes out differently, but the reality of it is the market was valuing the stock at somewhere around 17 to, we'll call it 19 or 20 times earnings. And we saw that Apple got, really highly valued as a result of that. But we also would want to notice that Apple had a very strong year here of over 71% growth. And I don't want to say that justifies the big run up in price, but it does help explain it. Yes. Okay, because its earnings do determine market price. You can see that ultimately, even in Apple's case, the stock went where the company's earnings went. And you can see that with, extreme examples like a company like Bed Bath & Beyond, whose, earnings are collapsing and they're, declaring bankruptcy. You can see that the price follows earnings. So that relationship is what FAST Graphs is all about, but it can vary from company to company. And because it's dynamic, when you change time frames, you're going to draw these, these orange lines are going to be drawn at different multiples. A 15 multiple is, by the way, a default multiple for most companies. And the reason for that has to do with things like earnings yield. And, father of value investing, Ben Graham, once stated, never pay more than 15 times earnings for a company. That's a very good rule, but like all rules, it has exceptions, and high growth stocks would be exceptions to that. But generally speaking, as you can see it here with Cigna, a 15 multiple, which is what this orange line is drawn at, and I can determine that by just pointing to it, is a pretty good proxy for value. The market has put a discount on this, at about a 12 multiple. So somewhere between these two lines is a realistic multiple. But again, this is a tool to think with, Eric. You want to, obviously, you can see that there was a period of time coming out of the recession of 08 and 09, the US recession, where, Cigna was trading at 7 and 8 multiples. You can see that by the orange.
Yes. Yep.
Number on the pop-up. So the point is, with FAST Graphs, it's an analytical tool. It helps you analyze and helps you make prudent decisions. And like one question that you did ask me, and I think it was the first question you asked me, and I'll use an example here of Echo Labs. Your question was, how do I explain how some companies trade at much higher than the orange line and can do it for even decades? Yes. Well, the answer is, I don't know. Okay. Yeah. The real answer is you can't really quantify irrational behavior. And let me try to explain that. Here's Echo Labs. Now, this has been a very consistent company until COVID. This is the COVID, quote unquote, recession, where you can see its earnings growth has been extremely consistent. So if I, scroll back to that time frame, you can just see how perfectly this company grew earnings at over 12% during this time frame. The market, however, applied and the number says 26.8. So anywhere I pointed to that blue line, I would get a PE of 26.8. But obviously the stock was trading below the line here. It was trading slightly above the line here, and so on. So, my way of saying it would be somewhere between 25 to 27 times earnings is how the market typically evaluates, Ecolab. So I would even just say, keep it simple and say, a 25 multiple is what you have to pay for Ecolabs. Now that begs the question. I've never owned this stock, even though I've admired its track record immensely, because I've never been willing to pay that kind of multiple to buy the stock. Because how do you justify a stock that's grown at just under 10% a year, trading at a 28 multiple against, for example, a company like AmerisourceBergen, who's grown earnings at 13% and trades at a 15 PE. I don't know how to rationalize that or justify that, Eric, but it is what it is. I can see it. With the beauty of FAST Graphs is I can see that that's happening. You have the same thing with companies like Coca-Cola, for example, which is, I call this a premium, multiple. The company grows at about 5%. It has historically grown at 5%. You can see very flat growth here. But the market, trades this at around a 20-ish multiple, and it has done that consistently. You can say the same thing about a name like Procter & Gamble. So there are stocks that do that. And that's why we have both the blue line on the graph and the orange line. This orange line, I like to call, first of all, both of these are valuation reference lines. I like to call the orange line the theoretical intrinsic value. That's what the stock ought to trade at. Based on its mathematical growth, its performance historically. The blue line is really how the market has valued the stock over time. And it's telling you, how the market, so, you could argue here and say, if you wanted to own Procter & Gamble, most of the time you had to be willing to pay about 20 times earnings to buy the stock. And if you weren't willing to pay that, you probably weren't able to buy it, except, interestingly enough, during the recession of 2008, we had a period of about 3 or 4 years where you actually could buy that pretty close to a 14 or 15 PE. And I want to say one other thing about this. The PE ratio is just a measurement. It's a barometer. It's not sacrosanct. It's not sacred. Okay. It gives you a guide, something to analyze and evaluate, because earnings yield is really what matters. And a 15 PE is a 6.67% earnings yield. That's why we list earnings yield here. I personally, as my own bias, I won't invest in anything that offers me less than that, less than we'll say 6.5% earnings yield or higher, because that's the average return stocks have given me. And that's a minimum rate of return that I'm willing to, accept, if you will, for making an investment. So when the earnings yield gets lower than that, like it is on Procter & Gamble, even with its normal, high premium valuation, it's now currently trading at 26 times earnings. And, that clearly to me is overvalued on any historical reference you could see. So it's a great company, AA rated, low debt, pretty consistent growth, great dividend record. The dividend yield is only 2.4% now, which isn't high enough. And I can, check that by its historical dividend yield. You want to buy this stock when the dividend yield, in my opinion, is somewhere in the 3% range.
Yeah.
As you can see here, when the stock was reasonably priced, that would be the ideal time to buy it. But I could also argue, but I can pay 20 times earnings for it and buy it when the dividend yield was in the 2% range and still make money over the long run. It's a matter of how much risk you're willing to take. I think Procter & Gamble is riskier at 20 times earnings than it is at 14 or 15 times earnings.
Yeah. Chuck, you just showed on your screen on the right-hand side as well the blended PE. Maybe you could just explain in a few words what's the difference between the blended PE and the normal PE, for example.
Well, there is no difference. Let me just explain the blended PE concept as clearly as I can. That's a good question, Eric, and I appreciate you asking it. I'm going to use a stock like I'm going to use Medtronic. Okay, because the real key is that when you're looking at calculations like the PE ratio, okay, the first thing you have to know is what metric are you measuring the PE ratio on? For example, here I'm using adjusted operating earnings, okay, which are, I like operating earnings because they eliminate a lot of the accounting convention, accelerated depreciation, one-time charges, non-cash charges, things like that are eliminated. This is more of a look at how is the business actually performing on an operating basis. Mm-hmm. However, you also have available in FAST Graphs basic earnings and diluted earnings. So I'm going to go to diluted earnings here, which I don't like as a valuation tool, but I do like to look at diluted earnings because they give me insights into whether there's a lot of, the company making acquisitions, or they getting massive charge-offs. It gives me a snapshot of how much accounting convention you might see in the company. But here's what I want you to notice. When you're looking here at Medtronic, if I went into a site like Yahoo Finance using the external links on FAST Graphs, which the tool is designed to help you research stocks, faster and easier. If I go into Yahoo Finance, for example, and click the summary and get a quote of Medtronic, I want you to notice the PE ratio they're showing is 24.35.
Yeah.
Okay. If I look at FAST Graphs and I look at, that same PE, we're using the blended PE, it's 22.46. But in this case, both cases we're using diluted earnings. Yahoo's using diluted earnings and FAST Graphs is using diluted earnings. Okay. If I look at it from an operating earnings point of view, which is a different metric, I'm getting a different PE, a PE of only 14, because again, this doesn't have a lot of the non-cash charges taken out of it. Mm-hmm. But here's the key. If you notice on a FAST graph, the graph goes forward, okay? It actually shows the earnings going forward. So let me talk about what Yahoo's doing. I want you to notice that when you see the PE ratio, it says TTM. Do y'all see that?
Yes.
That's trailing 12 months. Mm-hmm. And they're giving the earnings for trailing 12 months that they're calculating this PE ratio on of $3.22.
Yeah.
Okay, now if I go to FAST Graphs, I want you to notice that the earnings were 373 and yes, they're forecast at 333, which means the earnings are dropping. Okay, so when we're calculating a 22.46 in contrast, what you have to do is you have to solve for earnings. And what a blended PE is in simple terms, Eric, it's the number that's between the last actual and the next current forecast. So it takes into consideration past, present, and future, and a little bit of future earnings. Mm-hmm. When you use trailing 12 months, the reason I consider that not as accurate is because, first of all, companies usually take anywhere from 30 to 45 days or longer even to report earnings. So if you're using trailing 12-month actual earnings, by the time you're looking at them, you're already looking at earnings that might be 45 days to or longer stale. You're not looking at real earnings. What we're trying to do is give the best estimate of what earnings might be today. Okay, so how you do that is you want to calculate for earnings. All right, you've got a price, for example, here of $77.44. All right, yep. If I divide that by the PE of 22.46, all right, I get earnings of 344. This calculation on FAST Graph is based on an earnings of $3.44. If you notice, and I'm going to shorten the time frame, you guys can see this better. That is between the 373 that they earned, diluted earnings that they earned last year, and the 333 that they're expected to earn this year. So in this case, the earnings number is of $3.44 is actually higher than what we expect the earnings to be by year end. But that's what the blend is. It's past, present, and a small part of future earnings expectations. is just trying to give you a more accurate estimate. And you do see it on the graph because we list it here. But the blue line is the actual average PE that the market has applied over the time frame. And I want you to notice it's always different when you do different time frames. That's what makes this such a valuable and powerful analytical tool, is because it recalculates everything for you rather than just giving you a static look at the past. Allows you to basically see, you know, what's been happening. And for example, one thing it can do for you, and I'll use a stock like Microsoft as an example here to explain this. And I'm going to go ahead and switch again to operating earnings because they're a little more consistent. If you look at Microsoft, if I draw this graph as a long-term graph, I get 8.89% growth. But I also have a period here where 44% negative growth, and they have a June fiscal year. That's what's listed here. So if I eliminate that negative growth, my growth rate now runs to 12.95%. Now I'm still using a 15 multiple, but I've got a significantly different number. If I shorten the time frame again, my growth rate will adjust. For some reason it's not catching up. Let me do it again. There we go. Okay, I've got 15.84%. In other words, the growth rate has been accelerating on Microsoft, which I think partially explains, which was one of the first questions you asked, Eric, the enthusiasm for the stock. But, you know, are you willing to pay that higher valuation just because everybody else is? And as you can see, that valuation with a slight slowing down of, well, I shouldn't say slight, a slowing down of earnings expected, the stock, when it was trading at the high valuation, has become vulnerable, and it's been correcting. I still don't think it's cheap enough, but it is trading closer to what the market has been evaluating it lately. But again, it's an analytical tool. You have to ask yourself the question, are you willing to pay that? You know, or is it, you know, or will you be better off waiting? Because you could see there was a time, even in this time frame, where Microsoft was trading at that, you know, 14 or 15 or 16 times earnings number that I personally like better. So, you know, you could have bought Microsoft, and I think people forget Microsoft was trading at 9 and 10 times earnings back here. All right. So, you know, it's kind of answering two questions that you asked simultaneously. You know, the market gets irrationally exuberant here. They get excited, but there was some acceleration in growth. As you can see here at the bottom, if you can see those numbers clearly, I'll shorten the time frame again. These accelerations in growth where you all of a sudden got this $1.6 trillion company growing at almost 16% a year is incredible. Okay. And, you know, this is, you know, one of the, you know, 2 AAA rated companies in Standard & Poor's, and it's a terrific company. There's nothing I don't like about Microsoft from an investor's point of view except the valuation.
Okay. And by the way, I forgot to mention the disclaimer. Everything what we show today is only for educational purposes and is not a recommendation to trade any company. And Chuck, there's another thing on your platform which is quite interesting. It's the forecast, which is also a very important look to have in order to assess what could do the company in the coming years.
Yes. Okay. Now, my main point about that, Eric, is you can learn from the past, which is what we've been talking about mostly so far, but you can only invest in the future. So the valuations of most companies are going to be determined, you know, when you look at the historical graph about what the company did historically. But if you're investing in the future, you want to see what future growth potentials are. And FAST Graphs gives you really 4 forecasting options. The estimates and the normal multiple are both the same estimate data. Okay, they're just applying a different multiple based on either the normal PE or, you know, that's why it's a blue line, or what the orange line should be theoretically based on.
Yep.
Okay, and this simply gives you an indicator of, you know, where the valuation is. So technically this would be a loser if it went back to a 15 multiple, which again, I want to remind you, the stock has traded at a 15 multiple as recently as 2014. Okay, so this is kind of a what if game, Eric, and your viewers. You're saying, and this simply gives you 10% up and down increments of different valuations. So when you use the normal multiple, we're drawing the line at a 28 PE. Okay, and this is what your rate of return would be if that PE stayed at 28. This says if with that same growth rate, if the PE went to 15, you would have losses here and, would not make money. Now, these two estimates are based on the same estimate data, but they're applying different multiples. This is a trend line growth, long-term trend line growth. Analysts, and there are only 5 in this case, are saying 12.3% growth. So this would give you a different perspective. Again, we're using a 15 multiple, but you can point to different PE ratios here and run calculations, what if calculations, if it traded differently. Now, this is where you're using analysts with these 3, actually 2, because they're, these 2 are using the same. Getting analyst estimate data. Now you can corroborate that, like you can go to Yahoo estimate data here, for example, and you can look at, the long-term growth rate for the next 5 years from Reuters, which is who Yahoo gets their data from, is 12.88%. On FAST Graphs, we're saying 12.3. Again, I'd argue that's the same number, relatively speaking.
Yes.
Right? As far as the estimate data, you're getting 11.17 and 13.26. And if I went back here to Yahoo, went up to the top, you're getting 9.55 and 11.17. So you're getting a different, a different number because, again, you have to understand these are estimates. Okay, yes. So there's 9.51, 11.17. On here, you're getting, well, that's the same number. Actually, they're identical to what's on FAST Graphs. So these guys are basically, suggesting there's a pretty strong consensus of earnings here. Of course, you always want to check the analyst scorecard on each company because analyst estimates are only as good as how well the company guides them, number one, and how easy it is to forecast. So there are certain companies, like, for example, if you took a very cyclical company like U.S. Steel, where the analyst scorecard would be horrible. So if I'm looking at U.S. Steel, I'm not going to be, necessarily, I'm not going to rely on these estimates too much, but yet they could be correct. Don't misunderstand.
Yeah.
But I'm not going to give them the same credibility as I would give, for example, a Johnson & Johnson, AAA rated, which is guided analysts, correctly when I look at the analyst scorecard here.
Okay.
Now there's a 20% margin of error for the 2-year and a 10%. And what this scorecard is, to be clear, we're measuring how accurate the analysts were when they made the estimate a year in advance and how accurate they were when they made it 2 years in advance.
Okay.
With the margin of error. It's obviously naive to believe that analysts could be, perfectly accurate over time. They're simply,
Yes.
The only thing certain I like to say about the future is it's uncertain. That's basically what we have there. But, the idea here is what you have, my original mentor that I mentioned to you earlier, Eric, one of the things he taught me was, he said, you have to forecast. Your results depend on it. You have to come up with as reasonable a forecast as you possibly can. There's no reason to buy a company if you don't believe there's some future growth potential. Now, these 2 estimates give you analysts. The historical growth calculator allows you to pick historical growth rates. So to try to determine what's a normal growth rate for a company. And then maybe you want to be conservative. You can see that, Johnson & Johnson has grown 20 years at 8%, 16 years at 6.5%. That's been the lowest. 13 years at 6% has been the lowest. So I could choose that. And I could say this would be my most conservative case, that J&J will only grow at 6%. Or I can be more aggressive and say, I think this company is going to return to its 8.5% growth. And I can apply these estimates. And the point is, what you're trying to do is come up with a reasonable expectation of what the future might bring. And then FAST Graphs allows you to calculate what your performance would be automatically just by pointing to these points at different PE ratios. So you can kind of have a sense of what you might, be able to make. I like to say running the numbers through their logical conclusion. I don't want to buy a stock that's massively overvalued and, and not have a realistic assessment of what the future is going to be and end up losing money if I'm a long-term investor.
Yeah, and Chuck, do you also take into account the amount of analysts, or is it not that important?
Sure,
Yeah, okay.
Sure. The more analysts, the
better.
The more idea that it's a consensus. And the idea is you shouldn't rely on any of this. You should be doing your own work, but which, by the way, leads me to the last calculator, Eric, where it's a custom calculator where you can input your own earnings, your own dividends, your own growth rates. Okay, like for example, I've got a 4% growth rate here. I can enter, if I thought this stock was going to grow at 20%, I could enter a 20% growth rate and draw it. Then I could run my calculations. But the point is not what's accurate. We don't know what's accurate, but it allows you to then input your own data. If you have a difference of opinion from the analysts, or you don't believe the historical growth rates are going to give you that, then you have the ability to apply your own custom information if you want. Now, I'm being ridiculous here, putting 20%. There's no way, J&J is going to grow at 20%, but I could also, go the other way and put 2% in here and draw it at a 2% growth rate. And that's what, would happen if Johnson & Johnson quit growing. So, you have that ability. The idea of this tool is to help you make reasonable assessments of what the future might hold. And then, of course, my recommendation is you want to monitor that constantly, because I want to go back to one other things on this estimate data. One of the things we show down here at the bottom is 6 months ago, analysts were saying 1025. I got Johnson & Johnson here. 3 months ago, they dropped that to 1006. Their most previous estimate was 1005, which is where they're sitting now. But I want to point out, this is still an E because J&J hasn't reported yet. They're going to report probably about the middle of February sometime. That's typically 30 to 45 days after the quarter ends is when you actually get the real number. Okay, so this is still an estimate, but what we see here is that the estimates have been dropping. And so that would give you an idea of whether, the analysts were being, more negative or whatever. And that could do the things like inflation, economic recessionary fears, rising interest rates, a lot of things would come into play that would determine why analysts might be raising or lowering their estimates depending on the company.
And do you consider that a reduction of the estimate by 2% or 5% is a lot, or is it, I would say, in the margin of?
Yeah, because again, there's no precision in estimate data. That's one reason why we give you these, these ranges here, because, the analyst scorecard that helps me explain this, you should always look at analyst estimates as a range. That's why if you notice here, we draw it, we have an orange line. Let me take that. We have an orange line, and then we have, below it and above it. The orange line is a valuation reference, if you're looking at the original stock. But even with a J&J, you should always think of this. You should have a shading on the top and the bottom. It's not a perfect number. It's something reasonable. And that's what you're trying to do, is you're trying to make prudent, sound decisions. Nobody, as they say, that investing is not a game of perfect. So you can't invest in, perfect companies only, with perfect insight. You can only try to come up with some reasonable expectation of what the future might be. And then the only real defense you have from that point is you want to constantly monitor that, because these estimates on this estimate data, as you can see, but just by here, these estimates will change, and FactSet will report that as soon as it changes, and we'll normally have any estimate change on the graph in a matter of 24 hours or less.
Okay.
So if the analysts are dramatically, changing what their forecast is, a FAST Graph subscriber will be able to see that pretty quickly. And it does happen. The world changes. New information comes to fore, and you get a chance to see what the analysts are currently thinking, or what the company may have, had some reason. They may be taking some adjustment, or, who knows? There's all kinds of things that would cause estimate data to change. So, there's no substitute for comprehensive research and due diligence. FAST Graphs is designed to help you do that easier and more effectively, because we're trying to produce essential fundamentals at a glance. Now, you also have things like, the fund graphs and so on, because you also asked me a question, Eric, before about how do I determine whether, and Johnson & Johnson would be a good example since I'm on it, how you determine whether or not, the dividend is being covered. So what I would do is I would use operating cash flow, and I don't need to have the price on the graph in a normal PE. I can take that off. I want to see the cash flow, which is the orange line, higher than the white line, which is the dividend.
The dividend or the dividend yield? The dividend, huh? The dividend.
That just gives me a sense of safety that the company's cash flows are supporting the dividend. Now, that can change, as you well know. And if I go to free cash flow, this is, to me, is the asset. I want to make sure that free cash flow is covering the dividend, is higher than the dividend. And, that's not always the case. Now, you can also go into things like under the financial section, if you're a premium subscriber, and look at things like go to the income statement and click on the dividends, and then go into the cash flow statement and hit net operating cash flow. And you want to see net operating cash flow. You've got $11.2 billion dollars in dividends being paid out of $23.4 billion in cash flow. So in other words, the company's got plenty of cash flow to pay their dividend. Now, I can't think of an example right now, but that's not always the case. Here we see Medtronic's operating cash flow. That's diluted earnings. Well, their operating cash flow is still covering the dividend. I know one. Let's look at Eastman Chemical.
And while you check Eastman Chemical, Chuck, do you also check the payout ratio in order to assess the safety of the dividends?
Oh, sure.
Yeah.
Sure. Whether it's growing or shrinking is also a good point. And you see that very clearly in FAST Graphs. So when I'm looking at Eastman Chemical, if I'm looking at, free cash flow to equity, there are times when it didn't cover the dividend, but it's been covering it recently. Again, you're getting information here that helps you make a decision. This might not bother some people, it might bother other people, but let's talk about payout ratios for a minute. All right, what FAST Graphs does, I'm going to go to Church and Dwight here for a reason, because it's a good example. And this area, the white line, this is all the companies. I'm using operating earnings now, okay? This is all of the company's operating earnings, this dark green shaded area. All right. The white line is the dividend. The area below the white line is what portion of these total earnings that they pay out. So I can look at a company like Church and Dwight. I chose it for a reason. Back in 2004, they were paying out just a real small portion of earnings, of dividends. Of earnings. They were only paying out 13%. If I point to the white line, 13.7. But you can see in 2011, they increased that payout ratio to 30.8%. And you can see that clearly on the graph. And then you can also see now they've increased it to 40%. Okay. And if you look at, things like some of the oil companies today, where they've had, dropping earnings, you can see that the payout ratio is actually over 400%. And you also see that on the performance graphs, where we list the dividend payout ratio. So you can see when they had very high payout ratios. But here was a case. Why was the payout ratio so high? Because their earnings were collapsing. We obviously know what was going on with, energy policy. Now, in the case of a company like Chevron, here's where the operating cash flow becomes important, because even though their earnings were falling and so were their cash flows, they were still generally covering their dividends. They got close here in, 2020, and even their free cash flow. So again, we're using the tool to help us determine how safe the dividends are. Well, now I would turn to the balance sheet and look at how much, retained earnings they have, cash on hand. I would go deeper, because this would be a red flag to me that their free cash flow has not been covering their dividend. Doesn't mean it won't. That doesn't mean they won't continue to raise their dividend, but it certainly means it's going to be a challenge compared to, you know, what it was. Now, by the way, I've got about 15 minutes to help you with timing.
Yeah, okay.
So if there's other things you want to cover, you know, maybe now would be the time to put it in, because I've got 11:30. I turn into a pumpkin. I've got to leave.
Yeah, no problem. I think we covered already the main points. The last point also related to the dividend is quite important, because there's always a hype, a lot of people chasing high dividend yields, but sometimes forgetting that there are some other elements, fundamental elements to be taken into account, like the payout ratio, like the operational cash flow, etc. And I think this should be an attention getter for all the people watching this video. Do not just rely on the high dividend yield, but look behind the scene, look under the surface if the company is able to pay those dividends or not.
Yeah, I think that's a critically important statement you just made there. And the thing is, you know, a friend of mine calls those sucker yields. All right. And you know, the key is like, help me think of a mortgage REIT. I can't think of a mortgage REIT right now.
Yeah, I know REITs, but mortgage REITs are not my specialty either.
Well, here's a company. Here's a company I think I can think of that would help explain that. We've got a dividend yield of 18.5.
Yeah. Mm.
Okay, and this is, you know, Lumen Technology. So I draw this chart max, and I'll go ahead and put price on the graph. Well, what's happening is they've been cutting their dividend. They still got this crazy dividend yield. And, you know, then they finally eliminated the dividend, I guess. They're expected to eliminate the dividend totally because the business has been deteriorating. So there'd be a case where, yeah, that would be a sucker yield. That would be a real high yield. But it doesn't necessarily imply a higher yield could be a company like IBM that's in transition. IBM is offering a higher yield than normal because the company, you know, was growing real nicely in the past. Then they switched from mainframe computers to the cloud, and now they're starting to grow again. So they offer a, you know, 4.5%, 4.6% yield, but it's, you know, it's well covered right now by operating cash flows, and it's well covered by free cash flows. You know, forget the price on the graph now, the transaction. Yeah. You know, the point I'm getting at is they've got plenty of, you know, cash to pay their dividends. So yes, you don't want to just look at the statistic itself. You want to look at what's behind the statistic. Are the earnings increasing? Are they decreasing? You know, what's happening? And if I could just think of a couple of mortgage REITs. Mortgage REITs have a tendency to see their earnings dropping year after year after year. And so their yields become very suspect. They have high yields, but are they going to be able to maintain those high yields? You know, that's
maybe I don't know. Maybe you can try Angel Oak Mortgage, AOMR.
Let's try it.
19%.
That doesn't have.
No, okay.
Well, I tell you what, though. Let me look at something. Let me see if I can pull something out of my hat here. I know mortgage REITs. I just can't, for some reason.
You have PennyMac. You have AG Mortgage Investment Trust.
Give me the symbol.
MITT.
MITT.
Tango.
Okay, here we go. Yeah, this is a good example that I'm talking about. Because what's happened, you've got a high dividend yield here, but they slashed their dividend, looking at it, going into the performance tab of FAST Graphs, they slashed the dividend by 98% in 2020. Then they raised it by 800%.
Oh, yeah.
You know, so you're obviously looking at a company here. This is free cash flow has been deteriorating, and that's also why their dividend fell. So the question is, what's their dividend going to be in the future? And I'm not getting any. I'm either not getting an estimate or they've already cut it. I don't really know in this case.
Yeah.
This is what you'll see with mortgage REITs quite often, is that, you know, they have declining cash flows and earnings and often declining dividends, even though their yields can be very, very high.
Yeah. Chuck, Coming slowly to an end, I think there are a lot of people asking themselves the question, is now the right time to invest in stocks, or is it too risky? I think you are doing probably every day a lot of analysis of stocks, of indexes, and so on. What would be your opinion on this question?
Well, I'm very fond of saying, Eric, that it's a market of stocks and not a stock market. So to me, it's always a good time to invest in attractively valued stocks. And it's not a good time to invest in overvalued stocks. For example, if you were looking at a stock like Nike, again, it's a market of stocks, not a stock market. It's trading at a very, very high valuation, relative to what its earnings would justify. I would say it'd be a bad time to be investing. It was a bad time to be investing in Tesla when its price was high. If you look at a stock like Salesforce, you're seeing a lot of stocks that have had, they were great growth stories, but they've had, their price. So now would be a good time to invest. Last year would have been a bad time to invest in Salesforce. But on the other hand, there are plenty of stocks that are trading at attractive valuations right now. I showed you AmerisourceBergen before. It's not undervalued, but it's not overvalued either. Oh, by the way, I've got the new version of FAST Graphs up. I switched on you guys. This has some of the international stocks.
Oh, okay.
Sure how to use it. So do you have an international stock you'd like? My point is the market itself, I believe, is overvalued. I think the symbol is SPY. That's what I'm looking for. I couldn't remember the symbol. Yes. This is the S&P Trust. When the market was like this was not a good time. Back here was a great time to invest in the market.
Mm-hmm.
It's now trading below its normal. So we're getting many more stocks in the S&P 500 that are starting to become reasonably valued, but there's still a lot of high value. So the answer to your question is it depends on the stock, whether it's a good time to invest or not.
Mm-hmm. Okay.
You have a international stock you want to look at? I'm learning here myself now with you guys.
Can you put the Deutsche Telekom?
Yeah, I've got this one. I've got a cheat sheet here. Whoops.
Yeah, the Deutsche Post is good as well. The first one.
This would be one.
Yeah.
Yeah, this is the one I was trying to get.
Okay.
So we have it, and it's coming. Now we have a lot of little things, like we don't have the external links yet. You can't go into the corporate website yet. So yes, it is letting us in. That's interesting. They're making progress. So there's that's operating cash flow. There's operating earnings. There's sales.
So undervalued, obviously, a little bit.
It would be undervalued, but again, the caution I would have is are for slight weakening in sales going forward. Again, it's information that you'd want to take into consideration.
Yeah.
You have another one?
Yeah, you had the Deutsche Telekom as well, which was on the list directly after Deutsche Post, a very well-known stock in Germany.
Let's try it.
A Deutsche Bank is also interesting.
You might see this. All right.
Yeah, a bank. Yeah.
Yeah. And now, see, didn't that hit you just right, like in the forehead? What's happening to their sales? There's their operating earnings. Mm-hmm. It's cheap.
Yeah, it's cheap.
If you trust this.
Yeah.
So we're really excited about this. We hope to have this, in somewhere between the next 30 and 60 days. It's just a matter of them getting everything buttoned up and making sure there's no errors. We're testing. I've been testing it. I'm learning a lot, by the way, myself, just because I've never really had an opportunity to look at these international companies. And, but we've got, we'll have close to 80,000 symbols on here.
Okay, wonderful. Well, I will probably be one of your beta testers as well. Chuck, thank you very much. I know that your minutes.
It's been my pleasure. I hope I've given you some insight. I hope I didn't confuse you all too much. And
absolutely wonderful.
Thank you very much for having me on, and look forward to working with you guys in the future. Anything I can do, just give us a call.
Thank you, Chuck. I'm looking forward as well to the new features of your platform. Have a nice day, and maybe see you later another time.
Same match, Eric. And go ahead. I guess it's late on your day. Go ahead and some rest now. Thanks.
Thank
Appreciate
you.
it.
Bye bye.